Welcome to the Matt Waller Podcast, where we look at success at the intersection of technology, logistics, supply chain, retail, and CPG, also known as the retail value chain. I want to clarify that this podcast is distinct from my responsibilities as a professor in the Sam M. Walton College of Business. Nonetheless, it aligns with my aspiration to provide practical insights to professionals and business by showcasing companies and people that can enhance your ability to manage, lead, and strategize and market effectively in the retail value chain. Before we dive into today's exciting episode, I'd like to thank our sponsor, New Road Capital Partners. New Road invests in proven technologies, services, and products that serve unmet needs in the marketplace. They look for companies in supply chain and logistics, as well as consumer-oriented companies. For more information, go to newroadcp.com. I would also like to disclose that I am a strategic advisor to New Road. I'd also like to recognize podcastvideos.com for the services they provide for these podcasts. I'm very pleased with their services. And now, without further ado, let's get into the exciting episode. I have with me today Bobby Franklin, who is the President and CEO of the National Venture Capital Association. And if you're interested in alternative investments and venture capital, I think you're really going to enjoy this. We talk about so many interesting topics, but Bobby has incredible experience. He has been in this position. He's been with the National Venture Capital Association for 10 years, more than 10 years, but he has all kinds of other experiences that are related to that. And I think you're really going to enjoy this conversation. We talk about all kinds of things associated with venture capital, policy issues, how venture capital spurs on innovation and what innovation does to our country, and how important it is for our country. We even talk about the role of universities in this process a little bit. We talk about number of deals, size of deals. We talk about unicorn activity, mega rounds, a wide range of topics. And so I think if you're an investor, you should probably listen to this. If you're a high-tech inventor or early stage company founder, you should probably listen to this. It's definitely worth listening to. I learned a great deal from listening to Bobby, and I think you will too. Bobby, thank you so much for joining me today. I'm really excited to visit with you.
It's great to be here with you, Matt.
So one thing I'd like to start out with is talking about VC deal activity in the United States, including things like, the number of deals and the value of the deals, and how that's really changed over the past 10 years. Would you mind speaking to that?
I'd be happy to. And I can now speak to 10-year time horizon since I have now passed my 10-year anniversary as the president and CEO at the National Venture Capital Association. But it's also helped that our friends at PitchBook have data going back that far, and we can take a look at it like we do each quarter. What I look at when I look at these numbers over a decade is I see a continual increase in deal activity over a 10-year period. And sure, 21 and 22, we set records and all that stuff. But at the end of the day, whether we're reverting back to the mean or not, I look at this as a positive for our country to say that there is still capital being formed to invest in entrepreneurs that are starting and growing great companies here in the United States. And as long as that is a healthy line, and we would like to see it increase, gradually over time, things come in cycles. And so, like I said, we set records in 21 and 22 in terms of the total numbers. But as long as you see that solid line going up and to the right over a period of time, to me, that is a great story for the entrepreneurial ecosystem here in our country. So I look at that line and I'm proud of that line. And I think that more people, I wish, understood what that line represents and means, whether it's the competitiveness of our country, whether or not it's the opportunity for places like Arkansas or elsewhere in the country to create new jobs at a much faster rate than non-VC backed companies, whether it's creating anchor tenants like Scott Dorsey built a company in Indianapolis, sold it to Salesforce, and now he's got a thriving venture studio and operations in Indiana. I mean, those are what makes America great. And I love the deal activity line because to me, that's kind of a barometer of the overall health of the ecosystem.
Absolutely. And, Bobby, I know Ross Duvall, the CEO of Heartland Forward. And of course, I've known him a long time, even when he was with the Milken Institute. And he's done a lot of research over the years, that drills down into regions or even cities that shows that new venture formation is one of the best predictors of economic well-being of a region, not just the country.
I love the work that Ross does, and we try to amplify it every chance we get. They often will share when they're coming out with a report. We try to send it out to our contacts and channels to make sure more people pick it up. And you're absolutely right. He's doing very important work, and it's great work. It should show parts of the country that always feel like they're left behind or they're envious of what happens on the coast. It really should be shared more broadly, because any place that has the right ingredients can create an ecosystem that can do wonders for not only the people that are there, but the people that they will continue to attract, much like Northwest Arkansas has done.
Well, Bobby, I know you have done a really terrific job over the past 10 years of trying to educate lawmakers and people involved in regulation of the industry about the importance of venture capital to our country and to our well-being. And really, it's important from a defense perspective, too, not just from the health of our economic growth and so forth. Would you mind speaking a little bit about how you have done that and what you see in the future in that regard?
Absolutely. Thanks for the question. I think, one thing that a lot of folks don't stop and think about is, all right, we have great companies, we have great innovation, we have these wonderful products and services, and a lot of people don't stop to think, well, where did those come from? How is it that an entrepreneur is now providing a service to me? What happened in that growth journey? And the one commonality that so many successful companies and therefore products and services have is that they had venture capital backing in the beginning. And when we sit down with policymakers, we try to tell the story about how venture really got going in the 70s. And it got going after two important public policy changes happened. One was the ERISA rules, which allowed pension funds to be investors in alternative assets. And two was a significant lowering of the capital gains tax rate to incentivize longer-term investing. And when you put those two things together that happened in the 70s, coincidentally, around the same time that the National Venture Capital Association was founded, which was 1973, you saw this increase in companies being formed that were venture-backed. Now, some scholars, academics, have gone back and looked at all the companies that were formed since that time that have gone to be public companies. And it turns out over half of those companies have venture backing. And when you look at the subset of venture-backed companies compared to non-venture-backed companies, there are really interesting characteristics. First of all, a venture-backed company, the growth rate of venture-backed companies from 1990 to 2020 over a 30-year period compared to total private sector growth rate in employment. Venture-backed, 960% growth rate.
Wow.
Compared to 40% growth rate of non-venture-backed companies. So it's this high, we call it high growth, blitz scaling. I mean, this is where folks like New Road Capital come in at that growth stage when somebody's ready, they prove the concept, they know they've got something to sell, and they really need to scale up and get more salespeople and get more engineers to go to the next level, to service bigger customers and so forth. So, the annualized growth rate of VC-backed companies, 8.2% over that 30-year period compared to 1.1% of total sector. Those are the types of the stories that we talk to policymakers about so that they have interest in what are important public policies that help support the venture investing into entrepreneurs. And what can we get more of? And what bad things can we get less of? Unfortunately, in Washington, there's both good and bad.
Well, Bobby, this innovation to product to growth, that cycle of the life cycle of a firm, really, which requires, especially for high-tech companies, if you really want to scale, you've got to have venture capital. It's rare to be able to generate enough revenue and profit to be able to do that without it, especially when you're talking about things that require a lot of programming, expensive equipment, maybe even expensive regulatory hurdles to overcome. And then to scale, you need, as you said, you need people, you need processes, you need technology. There's just so much that has to go in doing that. But it's one of the things our country is still unequivocally the leader in. And it seems, I always, when I hear presidential candidates talk, being aware of this myself, I always wish I would hear them talk more about the importance of that and how they would try to even facilitate it further.
I couldn't agree more. I think it's too important to the success of our country and our country's future for there not to be a better understanding by anybody that has a role to play. That could be at the federal level for sure, but it also could be at the state level.
Yeah.
And even the city or region level. People having a greater understanding of the risks that it takes, the capital it requires, the talent necessary for these companies to grow quickly, because it's different than a mom and pop. It's different than an already established company. In fact, many times we in Washington have difficulty as we're talking to policymakers because they understand full well what a large Fortune 500 company wants or needs. There are legions of people, lobbyists and representatives of those companies that every single day are telling policymakers what's important to the largest companies in our country. And there's even a lot of advocates talking to policymakers from the mom and pop perspective. So the small business that's not trying to scale up and be a national business, but it's just doing what it does well. It's a restaurant, it's a dry cleaner, it's an independent coffee shop. It's something in that community. There are pillars in that community. The policymakers understand what's important to them. But what they really lack in understanding, I find when we're talking to them, is, but what about the company that's small by definition, but its desire is to be a Fortune 500 company? And its desire is to be a Fortune 500 company really fast. Folks at the Kauffman Foundation have done wonderful studies, and they've come to the conclusion in many of their reports that all net new job creation comes from these sorts of hyper growth, fast scaling companies. That's where net new job creation comes from. If you look at the large companies, they expand and contract depending on where we are in an economic cycle. And mom and pops, they come into business and some of them go out of business, unfortunately. And if you look at those over time, they're about equal and they stay relatively the same. But the net new job creation comes from industries, companies, products and services we didn't even know about 10 years ago, where some entrepreneur said, here's a new idea. Here's something that I think will be important. And they get a venture capitalist who's been through this cycle with entrepreneurs. They've probably been an entrepreneur themselves. So they can help them be on their team, help them grow the right way to be successful and to create jobs, frankly, out of thin air.
And the innovation that venture capital feeds for these kinds of firms is so important to our economy. One of the best ways to try to deal with inflation is through innovation, and a lot of research has shown this to be true. It can do things that no one would ever imagine. Bobby, I'm reading Walter Isaacson's biography of Elon Musk. I love Walter Isaacson. I just like how he writes. And this is the second book, biography of Elon's I've read. The first one was, I can't remember who the author was, but it was called Elon Musk, Tesla, SpaceX, and the Quest for a Fantastic Future. It was a good book, but this one is terrific. And the book is talking about how Elon Musk got involved in, one of the first companies he got involved in was Zip2.com. And I was an early adopter of that. And I remember back then, I tried it out. I used it on my computer, and then I would print it out on my printer because we didn't have smartphones yet. And I liked it. I thought, this is really neat, and it gave additional information. I had never heard the story about how they were funded and how they really developed this technology. But one thing that struck me too about reading this book, Bobby, is that some of the people that were involved in Zip2, which became a foundation for lots of other GPS kinds of solutions that even the ones we use today, Elon made a lot of money selling Zip2, and then he was a co-founder of PayPal. Now, some people might argue, was he a co-founder or not? But he went into that next. And but there's a whole series of things that, as you're reading the book, well, even like for example, reading about PayPal and seeing David Sachs was involved in that. I didn't know that. I knew Peter Thiel was involved in it and some other people. But when you look at this, not only does venture capital seed innovation in a particular company, I actually think it seeds innovation in people.
That is so true. And I'm listening to the audiobook that you're talking about, Walter Isaacson's biography on Elon Musk. And when I read or heard, listened to the chapter that you're talking about with Zip2, I thought, okay, he had a payout, and then he went on to do other things. And I wondered out loud, what if he couldn't sell that company? Would he have gone on to do the other things? My guess is, just given what we all have started to learn about him, probably so. But it's an interesting question, and what if? And it's interesting when it comes to public policy, because right now, we are facing a current administration that is not, let me start over. Right now, we're facing a lot of headwinds when it comes to mergers and acquisitions, when it comes to antitrust. We have a current chair of the Federal Trade Commission that doesn't believe a company buying another company is a good idea, by and large. And they're challenging almost everything. And that is already having a chilling effect. So if you think about the life cycle of many of these innovative companies, some companies are destined to become a public company and an IPO. Unfortunately, in this risky business, a heck of a lot of early stage companies fail and they don't make it. And the most likely outcome is a merger or an acquisition. And so public policy has a lot of impact on the success of this ecosystem. And it's another area that we talk to policymakers about, and you're hitting on it when you're describing this, because it's important for entrepreneurs and their investors. And don't forget who the investor is, right? It's the VC, but it's the limited partner that made the investment in that venture fund.
Absolutely.
And those are university endowments and their pension funds. Like I mentioned, that public policy changed back in the 70s that allowed pension funds to be investors. Their family offices, there are others. But those folks need a return. The entrepreneur needs a return. And most of the time, that entrepreneur becomes a serial entrepreneur. And a lot of times it's the third or fourth company that they founded that ends up being the life-changing product or service that we all come to love.
Absolutely. I think what you're talking about too, regarding some of the regulatory environment that we face, regulators a lot of times don't understand that if you just look at the history of regulation, you see the unintended consequences are abounding. They are everywhere. And unfortunately, we're not smart enough to know, well, if I do this, if I make it harder for a company to go public, or if I make it harder for a firm to merge or acquire another firm, then that's eventually going to make it harder for investors to say, I'll invest in venture capital. And that makes it harder for entrepreneurs to get capital to build their ideas. And all of that leads to stagnation in the economy, because if innovation is the thing that keeps us alive. And it can also hurt us from a defense perspective. But it seems like a lot of times regulators, if you look at their backgrounds, they don't have a lot of experience in this. And they are looking at what I would call a first level effect, not a secondary or tertiary effect. Because when you start looking at the compounding effects of some of these decisions, it's just, it's stifling. It's actually scary. It could hurt our country pretty seriously.
One we're dealing with right now, and it's just a few weeks old. Ever since the Bayh-Dole Act was passed, and you increased the activity with university research and commercialization and tech transfer in taxpayer money going to universities, which leads to groundbreaking research, instead of there being a white paper that sits on somebody's shelf, there have actually been lots of great products and services that have served humankind. And when you think about the fact that there's this political argument that we need to use march-in rights into federally funded research that may have been a small part of something, and this is all about the cost of pharmaceutical drugs. But there is an effort now to essentially undo what has worked so well for 40 years and use march-in rights to go on some political scavenger hunt about a solution that they think will, solve some problem that they have identified. Yet they have no idea what they would be doing to the entrepreneurial ecosystem and to innovation, because investors would not want to touch any sort of university research that had any federal funds attached to it, because they've called into question whether or not that intellectual property is actually intellectual property that is protected.
Wow.
So we are now faced with this issue where we're going to have to go and combat these efforts. And to your point, it's like they're narrowly focused. They have their blinders on. They have this one goal in mind, and they don't understand, or perhaps even worse, don't care what the collateral damage is. But it will be significant if this is allowed to happen. And all of the, and even thinking about it in the wake of what's happened over the last couple of years, which have been positive, where you had the CHIPS and Science Bill, which will increase funding that NSF and others can use along with universities to create more breakthroughs. I mean, we were stagnant on a lot of the R&D funding by the government as a percentage of GDP over the last several decades. And other countries, that's where they started becoming much more competitive, because they were using government dollars in research. And we haven't at the same level that we did 30, 40 years ago. And now you look at a possible change in public policy that going forward then would call into question capital allocators, inventors, and the rights that they have. It would be drastic.
It's horrible. I did not know about that.
It's just a few weeks old, but it's one that we're trying to get prepared for, and we're going to have to go to battle.
Well, thank you, Bobby, for going to battle for us. I appreciate that. Having seen, especially when you look at, a lot of people don't understand the importance of, university STEM research in particular. But it's true, like what you're saying is important. There's IP that's created that's really valuable and can turn into incredible companies eventually. And so personally, I think that universities need to be very generous and allowing inventors, students, and faculty to run with the ball. It's in the best interest of our country. But also, Bobby, the other aspect of this I don't think a lot of people see, and I've seen it because I've been in higher ed for 35 years, but being able to work in a lab and learning how to conduct research and invent new products or concept, that is so valuable. And we don't want to do anything to stymie that, because people come out of these experiences in working in labs. Sometimes they start their own business, or sometimes they go to work for an early stage company, and then they may eventually start their own business. But that learning how to do scientific research in a lab is extremely important. I think sometimes universities are getting attacked for some of the research that people think is not very helpful to society, maybe. But they're not looking at the STEM research that's going on. They're looking at some obscure, esoteric thing that isn't really funded in a big way. But when it comes to STEM research, I know, like here at the University of Arkansas, they have, there's a guy named Alan Mantooth that has done incredible amounts of research, and they're doing a lot of research on things like an alternative to traditional silicon chips that could revolutionize processing. So, and they also done a lot of work on nanotechnology. But yeah, you have some of these professors that are doing incredible work along those lines. But people often forget, there's a bunch of students there working on all this stuff, and then they go out into society and have a huge impact.
It's great to bring light to this issue. And one of the things that I've had the privilege over the last decade is to be on the front row and see universities across the country that do this really, really well. And what do I mean by that? I mean, they encourage, like you suggested, their faculty and their students to get engaged. They make it easy for faculty to take a break from teaching and to go into a startup, and for successful entrepreneurs and others to then come back into teaching. And it's, one could say, well, it's a bit of a revolving door. Yes, and everyone is benefiting from that. And you see universities that encourage their IP and encourage there to be some product or service that comes out of that research that happened. And sometimes you see universities that are on the opposite end of that spectrum. And many times they have, with all due respect to lawyers, who I have a bunch of friends who are lawyers, who feel like it's their job to protect the interest of the university if that happened there. And therefore, they actually smother an idea from ever becoming something real. And instead of the other way around, where the universities that are doing everything they can to help that idea become a successful company. And when you do it that way, the university ends up getting a lot more on the back end than they do on, a higher percentage of zero is still zero. And they should be encouraging new company formation. They should be encouraging new ideas, new products, new services, encouraging people to take a chance and go run with something. They're going to learn from that. The great thing about the United States compared to a lot of cultures around the world is that failure is not some shame on the family that then they have to go into hiding. Failure is one step closer to success. They have learned how not to do something. That means they're one step closer to actually doing what it is that they want to accomplish. And the U.S. has had this great culture around, it's okay if you don't succeed, try again. And I think that's some of the ingredients that have helped us become the innovative leader. But we can't take it for granted. And other countries have been studying us. They have been modeling policies after us. They have been forming capital. They have created venture capital ecosystems in their countries. And they're doing their darndest to outcompete us. And if we're not careful, we're going to make some bad decisions along the way that make it easier for them to do that. And so part of what I feel our responsibility at NVCA is to make sure policymakers and others are aware of how important this crown jewel that we created and invented is, how delicate it is, how bad decisions can greatly influence it, although it does so over long periods of time. And so decisions made now may not have the positive or negative impact for some time, but we have to be able to have rational conversations with one another about what those impacts are.
Well, some universities allow their professors, even encourage their professors, to be consulting with companies, whether they be early stage companies or late stage companies or starting their own companies. Others have really restrictive policies to where I've known of cases where an early stage company asked a professor to do some consulting for them. It was a STEM type of deal. The attorneys looked at the university's policy and said, we do not want this person consulting with us, this professor, because the university will have claim to any innovations that we create. And when you look at especially a public university that's supposed to be doing the public good, even though, you could say, well, the professor's making money on this, but they are, but that's great. If a company wants to compensate them for helping to innovate or develop a technology, then more power to them, And
it's going to make the professor that much better.
Absolutely. Yeah, because then the professor, when he or she is teaching, they have more practical insights into what's going on currently in industry.
Well, let me give you another stat. So, according to some academic research that looked at companies and their type of backing, in other words, whether they were VC backed or non-VC backed. If you look at the VC backed companies from 1975 to 2015, so a 40-year span, 0.18% of those companies receive venture backing. 0.18%. Yet, when you look at the current, this is of a few years ago, the current total market cap of public companies, the 0.18% of companies represented 57% of market cap. So the value that the VC-backed companies created was greater than the non-VC backed companies, even though it was barely over 0.1%. And what you're talking about and the opportunity for professors and others to be involved with as many companies as possible that create such value in our country is something that we should encourage each and every opportunity we get. And that's kind of the story of us talking to policymakers, is helping them understand how important it is for VC-backed companies to thrive and for the policies that help encourage new company formation for them to happen. So, another stat to prove the point, and the one that you're talking about, just about how important it is for universities to be engaged here.
That's great. Bobby, I want to talk to you about some trends now, but before we do, I want to talk a little bit about the structure of a venture capital firm or an alternative investment type of a company in general. But, you've got general partners, and they're very much responsible for the managing the company, the firm, and the finances and doing due diligence and raising capital, et cetera, et cetera. Then you've got the limited partners that are the investors, and they don't really have much say in what's invested in, but they're investing in the firm, the venture capital firm. Sometimes those limited partners will invest in the venture firm and simultaneously, in some cases, also invest in certain investments alongside the venture capital firm. And and so this gets into a concept that you and I had talked about before we got on the recording, crossover investors. And would you mind speaking to what is meant by crossover investors, and then let's talk about the trend we see there?
Yeah. So the way we think about crossover investors is when we look at venture data, our friends at PitchBook, who is NVCA's exclusive data provider, when we talk about crossover investing, what we're sort of talking about is capital not coming from a venture capital firm, but making investments into venture-backed companies. So you have different definitions of investors, you have different definitions of companies and whether they're VC-backed or not. But what crossover investing, the way we think about it, is firms that don't hold themselves out to be a venture firm, but they do make investments many times in the public markets, many times in, wherever they can. And they see opportunities. And certainly that's what we saw in late 2020, all through 2021 and part of 22, where the Tiger Globals of the world or some mutual funds or even some hedge funds and others looked around and they said, we see opportunity in these venture-backed companies that are late stage. They haven't gone for an IPO. They haven't had a merger and acquisition yet, but they might be ripe for that. We see opportunities there, and we want to go into investing into that asset class. And when you're looking at the industry, you realize that, wait a minute, there's a ton of capital coming in from outside the venture industry, outside of firms that went out and raised a specific venture fund. And so I think it's important to keep track of that, because as fast as sometimes crossover investors come in, many times crossover investors leave. And it's important to kind of keep track of that. So what we see now in the data is that a lot of those crossover investors that were here in 2020, 2021, beginning of 22, have largely left the asset class. And so now we're left to more traditional, how much has been raised by venture capital firms, how much dry powder is there. In other words, they raised a fund last year, they haven't yet committed that capital. It's still on the books and they can call it from the LPs to make investments when they're ready. And it's important to understand the industry by understanding when crossover investors come in and when crossover investors leave.
Bobby, what do you think is the reason for a lot of crossover investors leaving?
I think it coincided with when interest rates started to go up, when public markets were hit, when they had to look at the other obligations they had. When they were in the venture space, a lot of the valuations of those venture-backed companies started to shoot up. In fact, one thing we talked to our board today, they talk about some of their portfolio companies who they can't understand why they have to do a down round, or they can't understand why the value that they had the last time they raised money shouldn't be the same or higher value they have today. And part of that has to do with, supply and demand and market circumstances. And so I think that crossover investors came in when there was opportunity, and now they have left because the other economic circumstances have impacted their business so that they have to look elsewhere.
And if you wouldn't mind, I'd also like to talk about seed and pre-seed and the trends you're seeing there. But first of all, speak a little bit about seed and pre-seed, and then let's talk about the trends you see.
Sure. So seed and pre-seed, and these definitions continually change. And what I mean by that is if you meet somebody, if you go to a cocktail party with all venture capitalists, the way they introduce themselves to one another is to describe what stage they invest in and to describe what sort of verticals they invest in. That's sort of commonplace. So, common conversation between two VCs is, well, we invest in seed stage, Series A, average check size X, and we're in consumer, or we're in AI, or we're in life sciences, or we're in whatever. That's how people identify themselves to one another inside the venture industry. And so seed and pre-seed are really those very early stages. Maybe they've done a friends and family round, like they've got this idea. It's 2 or 3 people, a dog in a garage, proverbially, but they're really looking for some capital to see if they can get this idea off the ground. And, when I think about what's an important barometer for the entrepreneurial ecosystem, there are different steps along the way. I sort of look at first-time financings, which is, we can kind of look at that as, okay, these are the very first institutional checks that went to an entrepreneur. And I think it's important that that's always at a healthy level, just like, we talk about overall deal activity, as long as it's, over time up and to the right, that says that there are still entrepreneurs that are able to come to the venture industry and get their very first checks. And that's a good and positive thing. And a lot of times those can be those seed rounds or pre-seed rounds that we're talking about here. Although there are, over the last several years, and certainly when we were hitting, the records over 21 and 22, those definitions started to really change and get very specific. And people would say, well, I do pre-seed, or I do dirt investing, or they'd come up with all sorts of terminology in it. And when you look at the seed and pre-seed, I think to me, it's just like, what's the health of the industry? What's the health of the opportunities that the ecosystem has for entrepreneurs to take chances? And if you look at the information in terms of deal activity, as well as, either by deal count or by deal value, it's still higher. Now, it's lower than the last 2 years, but it's higher than 2020. And to me, that's a very positive sign.
So, Bobby, if you wouldn't mind speaking to early stage activity as well and differentiating that from seed and pre-seed.
So early stage is just past that, right? The early stage is sort of those Series A rounds. It's still a young company. I forget off the top of my head exactly how PitchBook defines early stage, but you can go to PitchBook's website and they can give you all that information. And the interesting thing, just as an aside, when you think about pre-seed, seed, early stage, growth rounds, and then when you're getting closer into what people typically start to refer to as growth activity, or even private equity, and some of the things that happen in private equity distinguished from venture capital, you can see differences in the different cycles, in the economic cycles. So, for example, when the public markets go down, that greatly impacts the later stage growth investors because they're closer to that public market. Whereas the stock market can go up, the stock market can go down, you can have all these things happening over here. That doesn't usually impact seed stage or early stage investing. It takes longer for that to trickle down to impact that. So when you have this, line and different stages of investing, you understand that different inputs impact what's happening at those different stages of investment at any given point in time. So you look at early stage investing, not unlike what we saw in seed and pre-seed. And again, we see that there was a lot of it the 2 years prior compared to this year. And even this year is lower than we saw in 2018, 2019, and 2020. But if you plotted that line and you looked at it, it feels like we're reverting back to the mean. And it feels like it's still healthy. It's still higher than it was in 2017, higher than it was in 2016. And the other thing, when you're looking at data with regard to venture capital, you have to remind yourself, all right, a venture capital firm, a venture capital fund, the LPs that invest in it, it's a closed fund. It's not like a hedge fund or something else where you've got redemption rights, et cetera. Those LPs are signing up for a 10-year period with this fund. And oftentimes, in fact, at our CFO task force meeting back in November, somebody asked the question, has anybody actually ever closed down a fund that was exactly 10 years? And hardly any hand went up in the air, meaning that almost every 10-year venture fund has provisions in the LPA, the limited partner agreement, that extends it for another 5 years and many times even longer. If there are still portfolio companies that are backed by that fund, and good reasons why you wouldn't want to kind of shut it down yet, because you still have some harvesting of those investments to do, then there's no reason to. So I lay that out there because it's important whenever you're looking at any data with regard to venture capital, you have to keep that in mind. And you have to think about vintage years. So even though, for example, this year's data looks a lot less than the previous 2 years, a lot of people that have been around this industry a lot longer than I have get excited because they know that, okay, the last 2 years had valuations that were really high, and some of those are going to have to come down. And investing now means more due diligence, and it means more finding the price that probably is the right valuation of that company. It means more discipline in how that company grows. And many times the investments that are happening right now will turn out in an average 7 or 8 years from now to be the better investments than the ones that happened in 21 and 22 when we were setting these data records in terms of the amount of capital in the industry. But again, you're at different valuations and you don't know how that company's going to turn out until several years from now. So you have to think about, okay, this is a really good time to invest because typically after you come off these record numbers, you're into the really, really good vintage years for an investment fund.
This reminds me of a famous quote from Warren Buffett. You know, he is known for saying, when everyone's greedy, be cautious. When everyone's cautious, be greedy. That may not be exactly it, but something along those lines.
I think there's a lot to it, right? And we will most likely see a lot of that bear out when we look at returns 5-7 years from now.
If you wouldn't mind, let's talk just briefly about what they call mega rounds, where the deal size for a round is greater than $100 million. Just from looking at, and I know the mega deal rounds are not like they were during 2021 and 2022, but judging from the news, just things that I read, I get the sense there's still, you know, in terms of the big picture over the last decade, there's a lot of, you know, mega deals, mega rounds occurring. Is that right?
Well, there is. I mean, according to the PitchBook data, you look at the mega deal activity and you look at 2014, 2015, 2016, 2017, and that was, I call that one sort of plateau. And then 2018, it more than doubled. And the next 3 years, it stayed almost twice as high as it did the previous 3 years. Then you had what we've been talking about, this 2021, 2022, which are kind of abnormal years. And you look at what we are seeing as a result of 2023, and it's higher than that plateau of 2018, 2019, and 2020. So you're absolutely right. The number of deals, the value of those deals is still very healthy. It's just not as much as it was the previous 2 years. And again, that to me coincides with those crossover investors, those non-traditional venture investors coming in and making investments in certain companies at high valuations, which really drive these sorts of data numbers, right? I mean, you can have one deal that makes a big difference in what we see in this data, because many times one mega round in some well-known startup at a later stage can make up for almost the rest of the industry. If you look at the dollars, I mean, that's so much activity is happening in these mega rounds that it's far bigger than what we see in traditional venture space.
And I'd like to get your thoughts just a little bit on life sciences versus tech, because, you know, and I know there's all kinds of life sciences investing, but I also know that from a deal count perspective, tech is about an order of magnitude above life sciences in terms of number of deals. But and a lot of the life sciences investing requires FDA approval or some kind of regulatory hurdle that the tech investing is not facing, and it really increases the length of time it takes to for a fund to recover, to have a realization of any of the deal. But would you mind speaking to that? What do you see going on? Again, I know 2021 and 2022 are kind of different, but in terms of the past 10 years, how do you see those trends going, life sciences versus tech?
Well, they look very similar, albeit they're at different scale, right? To your point, a lot of investment in venture happens in software tech companies because it's easier, cheaper. Sometimes you can get your return quicker than you can, to your point, in a life science company. But when we think about life sciences, it's, there are new categories that seem to pop up each and every year. You have your pharma, your bio, you have your medical devices, you have your digital health. Now you're going to have a subset of AI companies that are focused in the life science space. I mean, there are a lot of categories within the life sciences grouping. And back to what we talked about with regard to public policy, it matters. And I would give credit over the last couple of decades to changes that were made at the FDA that have helped us get to a better place so that venture-backed companies, which, by the way, are responsible for about half of the new drugs that are approved at the FDA each and every year. So people think about big pharmaceutical companies are the ones that are creating all the drugs. That's just not true. And in many cases, the pharmaceutical industry has outsourced their R&D to the venture-backed new companies that are creating new drugs. So you have this venture industry creating new drugs. You have a venture industry creating medical devices. One challenge between the two of those in public policy is that once you get FDA approval for a new drug, then CMS automatically reimburses for that drug. Unlike medical devices, where once you get FDA approval, you then have to start additional clinical trials to prove the cost savings. And so you have vastly increased the amount of time people must make investments and continue to support companies, whether or not they actually, at the end of the day, get to a place where they can be reimbursed for that. And that has had a significant drag on investment in medical devices. So it's another area that we talk to policymakers about. If we could follow the model that we did with regard to pharmacological products, then maybe we can see an increase in investment and new products and medical devices that are coming to market that can save lives and save money.
Yeah.
You've got the digital health, you've got the AI, you've got a lot of areas where people are focused on in life sciences, but it, like many other categories, you see this steady increase over time. Again, we may be reverting back to the mean considering the last 2 years, but you still see kind of an increase, certainly over 2019, and we're happy to see that.
I'd also like to talk a little bit about unicorn deal activity. One thing that brought this to mind was yesterday or day before yesterday, I ran across an article that was quite interesting. And it was looking at universities who have graduated students, alumni, that eventually go on to co-found or found a unicorn. And when we say unicorn, at least the way I understand it, unicorns are firms that have a value of over $1 billion. And the number 2 university in the world is Tel Aviv University in Israel. And it's a small university and in a small country. surrounded by its enemies, suffering a lot of times all kinds of challenges. Yet that little university, Tel Aviv University, has created the second most number of graduates who go on to co-found unicorns. That's pretty amazing. And I had read a book a while back, seems like it was 10 years ago, maybe more, I'm not sure, called Startup Nation, talking about Israel having lots of these high-tech startups. But that got me to, when I read that article, I thought, well, I have noticed again in the news, it seems like quite a few unicorn deals going on. Again, I could be wrong, but that's my perception.
Well, I know you're exactly right. In fact, I think in terms of value and even in number, we're where we were in 2018, 2019, and 2020. We've come down from 21 and 22, these what I would call outlier years, but we are still at that same level just before we hit those crazy numbers that we hit in 21. So yes, there's still lots of activity in the unicorn, and it is $1 billion or more. The other thing you point out by making the observation about what's happening in Israel is what we see as we talk about immigration policy here in the United States. And that is, there have been studies that looked at unicorns here in the United States and found that half or more than half of those companies were founded or co-founded by an immigrant. And that shows you that there's a lot of talent around the world that wants to come to the United States and start companies. Yet we have no visa pathway for an entrepreneur to do that. It's ridiculous. And when you talk to Republicans and Democrats alike, they both support this concept we've been pushing for nearly a decade and a half, called a startup visa. And if what it means is, if there is a brilliant entrepreneur somewhere around the world that wants to come to the United States to start and grow the company here with creating new U.S. jobs, and you talk to policymakers and they say, well, why aren't we rolling out the red carpet for them? And the answer is because there's no visa category. And even though it's supported by both sides, it gets caught up in all of the debates around all the issues related to immigration, including those at the southern border and those around Dreamers and DACA and everything else. And so we can't get it across the goal line. But I think it's important for us as a country to recognize that we have created and built this great venture capital ecosystem. There are other countries that are figuring out how to model it. And if there starts to be a competition among countries to attract the entrepreneurs to come to their country and grow it, we better get our act together. And we better have a way for those folks, whether they're coming out of Tel Aviv University, whether they're coming out of someplace in Europe, we better have a clear pathway for them to come and be in the U.S. to start and grow that company on U.S. soil. That's about competition. That's about innovation. That's about making sure we continue to stay a leader that we have so enjoyed.
Well, Bobby, it's really been a true honor and privilege to visit with you about venture capital and funding of these early stage companies. Thank you so much. This has been very informative. I really appreciate it.
Matt, it's been great to be with you once again. I've enjoyed it as well.
If you're finding value in this podcast, we greatly appreciate your support by subscribing to our YouTube channel. Additionally, following us on Apple and Spotify and leaving up to a 5-star review would be immensely helpful. We welcome any feedback or questions related to the podcast, as well as suggestions for further topics and guests. You can leave your comments on our YouTube channel, and rest assured that I will read each and every one of them. Please also take a moment to check out our podcast sponsors, as they play a critical role in keeping this podcast running. For more information on specific topics, timestamps, or links to articles mentioned during the podcast, head over to mattwallerpodcast.com.